The information provided on this podcast is intended to be educational and informational only and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.
Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malik, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner. How you doing, everybody? So today we have Ben Fraser, who is responsible for capital markets at Aspen Funds, having raised $75 million from high net worth investors. He's also the co-host of the Invest Like a Billionaire podcast. I'm super excited to have him on the show today because we met a few months ago at this point at the Intelligent Investors Real Estate Conference and had a pretty good chat. So Ben, could you start by introducing yourself, telling us a little bit about your journey so far in real estate?
Yeah, thanks for having me on, Ben. So like you said, I'm a principal at Aspen Funds and pretty much raise capital from high net worths. And we focus on mortgage note investing, as well as several other verticals, including multifamily, storage, and industrial. So really, we focus on kind of macro-driven investments in real estate and alternative investments that kind of fit our theses for where we think the economy is going and the best strategies to perform in those environments. So that's what I do at Aspen. And yeah, my journey here, I've been here about 5 years, but before that was a commercial banker and underwriter. And before that worked in kind of boutique asset management. But yeah, kind of had an untraditional path to kind of get into the private equity space. I was more on the debt side beforehand, but love it. It's a blue ocean. Like you mentioned, I run a podcast called Invest Like a Billionaire, and our whole goal is to bring education to alternative investments, real estate especially, for passive investors, and learning about all the things that all the benefits that there are of investing in these types of assets outside of the public markets that most people are invested in. And so that's really my passion, is helping people learn about these kind of cool opportunities. And as the regulations have changed, about a decade ago, it's really opened up a whole new opportunity set for investors. And I think we're still very early innings of the whole world of alternative investments, and really where people can invest in a whole host of things.
Yeah, awesome. It definitely seems like that. It's a lot of cool shifts going on in the financial markets, beyond just real estate. Obviously, as you got the crypto and all these cool developments. But yeah, let's take it all the way back to what's your first milestone in real estate?
Yeah, first milestone. So when I took the opportunity at Aspen Funds, it was really kind of an undefined role at that point. It was, hey, we're growing, we need help on a lot of different things. And I was actually, in my background is in finance and was a banker. And so originally was going to be kind of a CFO in training type of role, but very quickly they needed help on the capital raising side. And so, that was where I got stuck, and ended up actually loving it. So it worked out really well, but I had no background in capital raising. Had done a little bit of sales in previous jobs and kind of sales oriented roles, but actually going and finding out how to raise money was starting from scratch. And so, long story short, tried a lot of things and failed at a lot of things, raising capital and just trying to, beg for dollars to invest in our deals and our funds. But really, the first kind of milestone was, probably to this day, the single biggest check that I ever got from an investor was about a year after I started. He was a current investor, and my strategy was to go back to all of our current investors that we had at that point and just build relationships and tell them what we're doing and try to get more money. And he wrote a $1.6 million check, just on a handwritten check, and just handed it to me. I was like, never seen that much money in the account, but sweet. I hope it doesn't bounce. And that was kind of a cool confirmation of just how much capital there is out there in the world. And this just a normal blue collar guy who actually ran a pig farm and makes a lot of money, and looking for places to invest and looking for people to trust to invest with. So to me, that was really eye opening. And there's a whole world out there of a lot of capital available. So it really kind of changed my mindset of scrounging for every little dollar I could find to really creating an attraction system to where we can attract the investors that want to invest.
Yeah, that's awesome. That is definitely a pretty cool story. I love it. So, I mean, you've had experience in credit underwriting, asset management, capital raising, bunch of different sides of real estate, debt, equity, everything. So, what is the common denominator that makes a real estate deal successful?
Yeah, there's a lot of pieces there, and for those that are kind of just getting into the world of real estate investing, it's pretty exciting, and there's a lot of ways to make money. Coming from the debt side, I feel like it gave me an edge a little bit of the ability to kind of underwrite my own deals and to know what things to look out for, but also how to think like a banker, right? One of the challenges that sometimes we'll run into on a deal is we think the deal is going to perform in this way and it's going to be really good, and then the bankers are always thinking worst case scenario. So kind of putting myself in a position of how are they thinking about the deal? How can we prevent worst case scenarios or mitigate those risks to ensure that we get good financing terms? So to put deals together, it's debt is a really key part of that, but then also your equity. So you got to make sure that your equity is structured to where it's compelling to investors, and the offering makes sense for the risk that they're taking. But for folks that are kind of just getting into it, the biggest thing I always say is just educate yourself as much as you can. Because there's a lot to learn. There's a lot of people that have been doing this for a long time, and find the people that have been doing this for a long time and doing it successfully, and mimic what they're doing, and try to learn what are the things that they're doing right. And this kind of world of private equity, it's unique in the sense that there's not a lot of external confirmation and where people get comfortable in like the public markets where it's all public and transparent. There's a lot less of that in the private equity market. And so for investors, it can be challenging. So they generally want to invest with people that they know. And so building relationships, networking, understanding how the deals are structured, and putting all the pieces together. It takes a lot, but once you kind of start to get the wheels turning and put deals together, it all kind of comes together, and it's pretty remarkable what you can do. The difference in effort between doing a duplex or a fourplex deal versus doing a 50 or 100 unit apartment deal is very incremental. It's very, very small difference in level of effort. And so, the bigger you think and the faster you can get up that spectrum, the more success you're going to have.
Yeah, you can scale it. Everything kind of scales up, and it makes it, it's pretty powerful. So yeah, I mean, beyond learning, which obviously I have a lot of interest in doing, what are like the skills that an aspiring real estate entrepreneur should, spend time developing?
Yeah, I think the big thing is you got to be good at sales. You got to be able to, sell yourself, sell your deal, and on both sides, not just to investors, but also to brokers and to sellers of deals. And right now, the biggest challenge is finding good deals. And so, having an element of hustle and stick-to-itiveness is really, really key. And finding, one of the things that I always promote as well is finding partners that complement your own skill sets. Finding out what you're really good at is really important, because you're always going to do better in a role that you're naturally, inclined to do well at. But the really cool thing about real estate that's very different from other things I've done is it is very collaborative, right? There's a lot of kind of key roles that can be differentiated, and different people have different skill sets that fit those roles. And when you kind of put them together, you can create a really, really great team, and you can go farther together. And so, I've known several people that have kind of gone on their own and, kind of do all the pieces of the puzzle, and they're doing, flips, they're doing Airbnbs, they're doing small multifamily, but it's just kind of whatever you can get. And it's sporadic, it's haphazard, it's hard to scale, it's hard to keep track of things. It's always, moving money around and trying to make sure you don't run out of cash, right? So, you can do it that way, but I think it's actually better for the long run to find good partners, which is a whole other topic, but then finding partners that can do things that you're not good at, and you can help scale together and go a lot farther by zoning in on one particular niche. So that didn't exactly answer your question, but I think one that the biggest skill is finding what you're good at, because everyone's going to have different skills. And whether that's finding the deals, whether that's raising the capital, whether that's underwriting and structuring the deals, doing the asset management, those are kind of all the kind of big key components of any one real estate deal. Finding out what you really like and what you're really good at, and then finding other people to fill the gaps and kind of create a team.
Yeah. So, I mean, I guess this is for my own personal, progress in a way, but I mean, how do you discover the things that you're good at? Like, what do you do to figure out what you're really skilled at? Because I mean, at this point, I find all these things in real estate and actually almost everything in the world interesting. So, I mean,
Totally.
right. And there's like a couple of things I know that maybe you're not exactly for me. Like, I don't think maybe the boots on the ground things are as interesting to me as the interpersonal and like connecting with people aspect. And then some of the more behind the scenes, like finance things, like I like those too, but like, how do I guess then second that, like, how do you find a partner to meet those skills too, after you figure out what skill, like the skills that you are realizing, like the ones that you want to pursue?
Yeah, it's a great question. It's not an easy answer, because I don't think it's, here's the formula that you
Right.
plug in and you figure it out, or here's the test that you take. But I think it's self-discovery, right? And I think there's just an element of that in everything that we do. And over time, you're going to learn more about yourself, right? And the more that you can do that quicker, the faster you're going to kind of get into your power alley. For me, I never raised capital before, and I'd been in kind of sales oriented roles before. And I always loved talking with people, and loved explaining concepts and breaking them down. But I never had been in that role, so I didn't know necessarily I was going to like that. I also like the finance side of things, because as an underwriter, I like numbers. It comes really easily to me. But I also couldn't imagine myself sitting in front of a computer not talking to anybody for 8 to 10 hours a day. So it's kind of part of this, that self-discovery a little bit. What are you naturally good at? What do you like? Do you like talking with people? Do you like building models and crunching numbers? Do you like getting out, hitting the streets, and calling on owners, calling on brokers, finding the deals? Do you like doing the asset management, maximizing, optimizing a property or a business plan or whatever? And part of it is you got to just kind of get in the mix to see what you naturally gravitate towards. So I think just getting the ball rolling and just getting involved, and at first doing everything, you're right, and just seeing what you like doing and what you're good at. But I'm kind of like you. I like everything. So for me, I love the capital raising. I like the underwriting. I like the asset management. The finding the deals is not as much my strength, but the other three I do like. But I'm not the best underwriter. Like I'm good at it. I know how to break down a deal, but there's people a lot better than me. And then asset management, that's a lot more detailed work, a lot more just spending time maximizing the finer points of things. I'm more of a big picture guy, so I like to have a handle on it, but it's not my major strength. So capital is what I really like doing. I like structuring the deals, and so you kind of just figure it out as you go. And just getting involved in deals is the best learning experience, right? To kind of see what you gravitate towards. And even if you like something, you may be slower at it than you are at something else, right? And so you find like, hey, you're maybe moving too fast or something, or you lose interest in one particular aspect. And that's usually a good indication that, maybe that's not the main power alley for you. But finding partners, that's a lot, easier said than done. I think, the easiest way to kill a deal or to kill a, partnership is to find a bad one. It's one of the bigger challenges is finding good people to work with. But a lot of times, you already have them in your network, right? You already have people, and a great way to just go to networking events, go to meetups, just meet as many people as you can. That's pretty cool. I'm about to interview a guy on a podcast who he has never met his co-founder in person.
Wow.
Isn't that crazy?
Yeah.
I was like, that's kind of surprising. And they started a whole kind of tech company and online advertising platform. But I thought that was really fascinating, and it kind of, the limitations become less and less as we become that much more virtual in this day and age. And so I think meeting people, finding people, doing deals together, like, location is a lot lower on the list of priority of where you're at and finding people to work with. But for, starting out, it's just get in the mix, work for free as much as you can, or as close to free as much as you can, right? And just to get involved and around people that are doing deals, having success, you're going to pick up so much by osmosis and just by kind of seeing a deal work together. And then, serendipity will hopefully find you and help you meet your partners that kind of, have complementary skill sets. It's for me, all the people I work with, they're either, family, friends, or people that I've known for a long time that it kind of makes sense and it just happens, right? It's you're working hard, you're trying to find the deal, trying to find, the opportunities. And then once it happens, you got to have the eyes to see it.
Right. Yeah. That makes a lot of sense. And I think a lot of the things that you said that interest you and that you like to do are similar to the things that I like to do. So that's kind of funny because I'm also going this summer to be to work on the debt side in multifamily at Lumen. So
Great.
Yeah, so I'm gonna be underwriting a lot of deals and learning a lot of that stuff. So let's see if that's my thing, but definitely excites me. So I'm excited to get into the weeds there in New York City. So
That's exciting.
yeah, definitely. So I want to talk a little bit about Aspen Funds. I know that you have some income funds, but I kind of want to talk about what that is compared to a growth fund. And then also, could you tell us a little bit about Aspen Funds and what you do?
Yeah, you bet. So, funds are a little bit different than syndications. And the way I kind of break it down for those that are kind of newer to that terminology, syndications are generally what you see for the purchase of a single, say, multifamily property is probably the most common, and basically raising money to go purchase a single property. A fund is generally multi-asset. So there's going to be a lot more assets than just one asset, and you're raising, a fund around a particular strategy. And you're going to buy a lot of assets in the portfolio, and you raise capital into the fund that it gets diversified across multiple assets. And so in our case, we're doing fund structures for most of our deals, and for our offerings are buying debt. And so we buy both distressed debt as well as it's called reperforming debt on single family residences. And so that's kind of where we cut our teeth. We started there about 10 years ago and started building kind of our track record and our team around that strategy. But for us, it's really, kind of the two approaches of income versus growth. We structure our funds differently around those strategies. And, our growth funds, we're generally buying, non-performing mortgages and generating an exit, through usually an amicable solution of helping them get back on track by paying again, doing kind of a discounted settlement agreement with them, or worst case scenario, we have to foreclose on the property. And then the performing strategy, our income strategy, is pretty cool. It's pretty unique in the sense that we're buying these are mortgages that are performing. They're making payments every month, but it's kind of called scratch and dent loans or paper. So these are not the banks don't generally want to hold these because they're usually restructured, which requires a bank to hold additional capital on their balance sheet to reserve against the loans. And a lot of times, they they may miss a payment here or there, and so it's not a perfectly performing piece of paper that they can go and sell and securitize. And so the general will sell those off on the balance sheet, but they sell them at a nice discount. So we buy those usually at a 20 to a 50% discount of what's owed. And by doing that, it creates a really nice yield for us. And it creates nice capital protection for our investment. And we are secured by the property. So ultimately, it's pretty nice kind of risk adjusted return. We pay out kind of monthly income on that. So yeah, those are kind of our two legacy strategies. We continue to operate those, but we're actually kind of in the middle of a transition right now, which I'm pretty excited about. And part of our background as our management team is really focused on kind of macroeconomics and in focusing on identifying the trends that are going to be creating opportunities going forward in the economy. And really how we started in the mortgage notes was finding this little opportunity that was created after the Great Recession, after the big mortgage crisis, right? There was a huge just glut of these distressed mortgages that you could buy for pennies on the dollar at that point and generate really good returns. So our kind of core has always been finding opportunities in the market. And so we're actually shifting into operating deals in a variety of real estate verticals that we really feel are going to benefit from the economy and the kind of trends going on. And so other things we're excited about are multifamily, self-storage, as well as industrial. And really right now in this environment are finding asset classes that are going to be inflation protective and getting good debt terms in place on these projects and being able to have inflation protection on the revenue side of our finances. And we're going to perform well in this environment if we can do that.
Yeah, that makes a lot of sense. And then what are the kind of the advantages to investors for being in one strategy or the other in terms of the offerings that Aspen Funds has?
Yeah, it's really, we kind of still break all of our offerings, whether it's notes, whether it's multifamily or storage or industrial, across kind of the income or growth, right? And usually sometimes you can get both in a deal where it's kind of cash flowing day one. There's got maybe some value added components that you can increase the value of a property and increase, the equity. But a lot of times, we're finding opportunities that kind of fit more into one or the other strategies. And so it's really an investor preference, right? It's as an investor, you got to evaluate what are your goals, right? If you're kind of younger and you're looking to grow your net worth and you want to maximize the overall return, and you already have income coming in from, say, a W-2 or other active real estate that you're doing, you want to focus more on the growth side of things and find ways to maximize your dollars to get that compounded interest working for you faster, and also deferring as much taxes as you can. And then the other side of it is the income. So we have a lot of investors that are kind of in retirement or approaching retirement. And one of the biggest challenges for a lot of investors right now is finding good yields, finding good income that they can generate off of their net worth, right? So now they've been working for 30 years and have a nice net worth, but now they have to live off that. So instead of taking draws on their principal, like most traditional financial advisors recommend, if you can invest that into cash flowing assets or cash flowing investments, then you can live off that income passively, which is, an awesome goal to have. And so we kind of break it down by investor appetite. We're doing a lot of development deals right now. We kind of view development as a big opportunity in this market where there's a really a big supply demand imbalance in several verticals, and you're going to get some outsized, risk adjusted returns in development. But the challenge with the development deal is you don't have any cash flow for sometimes up to 2 years, right? Because there's a period of construction, a period of stabilization. And on the flip side, we have kind of our funds that start paying current income, right away on a monthly basis. So it's really we kind of design the fund to fit the asset, and then we go and market those funds to investors that kind of fit the profile of the returns that are going to be generated by that offering.
Awesome. Yeah, definitely. So I know that, one of the things I love about your podcast is the very in-depth, like astute economic perspective. So I kind of wanted to touch on a little bit, like what are the trends that you guys are investing based on, and then kind of with all this interest rate talk, like what do you think interest rate, or how you, I guess, mitigating risk of interest rate increases, or like where do you think the interest rates might be going in reality?
Yeah, great question. And yeah, it's something that we really focus on. It's something that drives a lot of our kind of investment thesis for deals that we want to invest in. And some of it kind of seems opportunistic, but we have kind of a pretty rigid structure and filter that we evaluate deals through. So first and foremost, we want to make sure at the macro level, at the high level of the economy, what are the trends that are happening, and what are the things that we can reliably say this is going to be happier for the next couple of years? Because a lot of things in the economy don't shift overnight, right? And in the stock market, there's volatility, there's huge price swings that reflect a lot of it is based on emotion and other things in the market. But in the economy, it's a huge ship, right? It's a multi-trillion-dollar GDP, and it's it takes a lot to move this big Titanic of a ship. And so you can generally have a good sense of, from a broad strokes picture, where things are going to be going, looking at supply and demand in different areas and what that's going to impact. And so from there, we kind of create our theses of what we think is going to, the trends that are going to be in play. And then we look at what are the asset classes that are going to perform best in that environment and those trends. And then what are the best strategies to exploit those opportunities. And so I kind of already alluded to a couple of them, but development we kind of see as a really big opportunity in the particular verticals that have systemic supply demand imbalances. So multifamily, there's a lot of demand drivers for multifamily right now. And even though there's been a big increase in rents over the past 2 years, there's still an affordability issue as housing prices increase, as interest rates increase, that decreases affordability, and household formation continues to get pushed out for people wanting to buy homes, and it's getting more challenging, and so it's pushing a lot of people into renting, and multifamily is going to be a big beneficiary of that. So that's something we're looking at. But within multifamily, so we have identified an asset class that's going to perform well in an economic environment, but we're looking now at comparing, was it better to buy a Class A stabilized asset, or is it better to buy a Class C value add asset, or is it better to develop multifamily? And so we kind of play in a few different areas of that, but we actually see a huge opportunity in development. Like right now, for Class A, A minus development asset, we can go build in certain markets for say $160,000 a door, but we can sell it at say $220,000 a door once we're done. So with those kind of numbers and those kind of metrics on the development spread, it makes a lot of sense. So where we're looking at inflation, everyone knows inflation is a big issue, right? And your cash is on fire right now at 7% headline inflation. That is over, I believe, 10 years, the purchasing power of your dollar at a 7% inflation rate decreases by 50%, 50. So it is a massive problem for people that are savers, right? That are not investing and just sitting on cash. And it's really important that you can invest in inflation protected assets. So we want to look at what are the asset classes that are going to be inflation protected. And so we talked about this recently on the podcast, but the best way to kind of view that is, where do you have pricing power? What asset classes do you have the most pricing power? And what that means is, can we push our rents, in a particular asset, relative to inflation? So multifamily, they're generally shorter term leases, and it's, got some level of price inelasticity, as long as you're in a market that has, a submarket that has good median income and some good wage growth and those kind of things. But, multifamily is generally pretty inflation protective. Another asset class that I really, really love, though it is challenging to find good deals in, is self-storage, because it's probably one of the most inelastic price sensitive asset classes there are, right? Because a 4 or 5% increase in rents for multifamily can be kind of substantial. That's potentially $50 to $100 a month increase to your renter. But in self-storage, where the average, dollars that someone's spending on a monthly basis are under $100 a month to rent the piece of storage unit, the 5% increase is only $5 in that case, right? So it's a pretty insignificant increase, but it's goes straight to the bottom line, increases NOI, and NOI is what drives value in commercial real estate. So it's very, very powerful. And then again, I already alluded to it, the other big kind of trend we're seeing is just supply shortage. We're seeing it in a lot of these asset classes, including self-storage, including multifamily, and industrial as well. So another asset class we're very bullish on is industrial. It's been in a secular bull market for a long time, as e-commerce has taken a big chunk of the economy and is continuing to grow. But there's actually been an even more recent phenomenon that is accelerating the need for more industrial, which has been caused by a lot of the supply chain challenges. So it's you kind of hear, maybe you've heard of just-in-time inventory, right, from your school, if you have any kind of supply chain classes or whatever. And it's basically, the whole idea was globalization. We kind of create this amazing supply chain, and we can get products shipped from China to your door within a short period of time, right? And it's just in time. Well, with COVID, that kind of threw that whole model into a big challenge, because as we all know, there were all the supply barges sitting off the coast and couldn't get the stuff off the boats. There's major issues with getting very seemingly insignificant parts, like car manufacturers, for example. They couldn't complete the cars because they didn't have the chips, right? And just these tiny little chips were throwing the whole thing into a big challenge. And so a lot of these bigger car manufacturers, a lot of the bigger companies like Amazon and others are onshoring. So they're actually wanting to build more industrial warehousing in the U.S. to remove that risk of reliance on supply chain. And so again, another big opportunity there. And then we're always kind of looking for kind of inefficient markets. We're looking for different areas that have these kind of opportunistic aspects to them, and distressed debt is one of those that we're going to continue to operate, and we really love that space. So that's where we see a lot of the opportunity. And finding the deals is the key, right? Finding the good deals that are going to perform in an outsized way, and that's really our goal.
Awesome. So I want to make sure we have time for the lightning round, and I think we've touched on it a good bit. But I just want to quickly touch on, what does it mean to invest like a billionaire, and how are billionaires doing it differently than us? And what can we do to be more like them?
That's right. Yeah. So that's the whole concept of our podcast, Invest Like a Billionaire. And the whole idea, and really where we kind of come with that idea, was as I was doing research on how the wealthy invest. It was very, very shocking, right, to see that the billionaires of the world, the institutional investors of the world, the really smart money, most of their portfolios are in these private equity and private real estate deals. And in most of their capital, generally 50% or more is not invested in the public markets, where the average investor is about 95 to 100% invested in the public markets, right? It's kind of all that they've, been told is available. But if you look at these ultra wealthy investors and how are they investing, that's different. It's alternative investments are the number one biggest difference. And it's really kind of broken down between, real estate and private equity, as well as hedge funds. And those are kind of the big three of alternative investments. So it's, that's kind of the whole thesis of our podcast, and really trying to understand how are the wealthy investing differently than the average retail investor, and how can we model our portfolios and our strategies around what they're doing, and have same or similar success that they have.
Awesome. Yeah, that's definitely a good place to aim, and there's a lot of good content coming out of your show. So definitely recommend checking it out. But so you ready for the lightning round?
Ready? Let's do it.
All right. So what superpower would you want if you could choose any?
Any superpower? Oh man, it has nothing to do with real estate, but flying for sure. It's a no-brainer.
On the couple shows before, we've realized it does have a lot to do with real estate because you can check the roof and make sure and do
Okay.
comps because you fly.
Hey, there you go. There's a lot of application there.
Right. So what's your favorite book, or what's the one that's helped you the most?
Oh man, so many books. Related to real estate, one that I am reading right now that is really, really excellent is Brian Burke's book. Actually, I have my desk right here, called The Hands-Off Investor. And it's really kind of a great guide for the passive investor to, understand how to break down a deal, how to do due diligence on a deal, how to find operators, how to know where to invest and what to invest in. Really excellent book, and just kind of sharpening the tools reading that book. But it's given me lots of great content.
Great. So what motivates you to continue every day?
Yeah, it's kind of, initially it was about accumulation of wealth, and I'm still on that journey, but I'm at a place where I just love what I do. I love helping people allocate into these really good deals, and be able to find deals where we can all win is really, really fun. I think ultimately for me, it's about creating a legacy for my family, and I ultimately want to do a lot of cool philanthropic things. So being able to create resources to do a lot of good in the world is my kind of ultimate goal.
And what advice would you give to someone who wants to follow in your footsteps?
Yeah, just keep going. Be super curious. I think that's something that has always helped me, is just ask a ton of questions, and be borderline annoying when you're learning something, because people are very willing to help people that are hungry, people that are curious and want to learn and want to grow. And that's probably the number one contributor, is I don't necessarily work harder than anybody else, but I just don't stop. I just try to learn as much as I can. I learn as fast as I can. I want to iterate and improve and get up the scale as fast as I can. That's been probably the biggest contributor.
So since I put you on the spot, I want to give you a chance for revenge. Ask me any question you want to know about me.
Oh man, I want to hear more about what you doing this summer, and working on the underwriting.
Yeah. So I'm working at Lument in New York City. They're a multifamily lending firm platform. They do asset management. They do all things across the whole country. But yeah, I'm gonna be screening potential candidates for deals before they become originated, and they do a lot of work with the GSEs, a lot of agency work, but also have it's actually, Lument was recently a merger of, I think last year, of 3 other companies. I don't remember the name of each of them, but like they've just combined a bunch of capacities. So like I'll get exposure to a lot of different parts of the industry and a lot of different asset classes and different competencies. So I'm really excited to get that broad experience, see a lot of deals, hone my skills, and network in the same space that I've been networking in for a while, the middle market, private real estate deals. And yeah, they do a lot of bridge stuff as well off the balance sheet, because I got a big I guess international backer. So it's I have a lot of cool products that I could learn about, and I'm excited to do that. And yeah, so it'll also be fun to go check out New York, see if the taxes and the expensive rents are worth it on a 3-month trial basis. But yeah, I'm very excited for that, and hopefully I could help maybe I could help you. Maybe I could help some of the other people I met at IREC with some loans. I want to be the first intern to originate a deal. So
Okay.
keep me in mind if you ever need any of these awesome products. I know you like good debt.
A great goal, man. You're going to learn a lot. That'll be exciting.
Definitely. Great. So where can everyone reach you if they want to find out more? And do you have any final remarks for the audience?
Yeah, no, it's awesome. I think you hit a lot on it. And I think just getting started. And for those that are kind of just, get into the mix, challenge yourself to think bigger. I think that's always something that's we limit ourselves by what we think we can achieve, and then when you achieve that, it's like, actually, it wasn't that hard. I can do a lot more, and it's kind of this stair step process. But if you can make big jumps and shortcut the process, you're going to get a lot farther than you think you can go. I know that was the case for me, where it's really within a 2-year period, it went from like 0 to 100, and there wasn't that much difference in effort. It was just thinking bigger and just believing I could do it. So that's a big expectation, I would say. And then reaching me, our Aspen Funds. It's the website is aspenfunds.us. And our podcast, you can go to thebillionairepodcast.com, called Invest Like a Billionaire. We're on all the platforms, and check out the show.
Awesome. Well, I recommend you do that. And Ben, thanks again for coming on. It's been a great conversation, and I'm sure everyone will learn a lot from this episode. So thanks again, and hope to see you in the conference soon.
Sounds good. Thanks a lot, man.
Awesome. Before you go, I just wanted to say thanks again for tuning in to another awesome episode of Real Estate Milestones. If you've been enjoying the show and you'd like to offer your support, please leave a 5-star rating and review on Apple Podcasts. It's the best way to increase the show's visibility and help the message get out to a greater audience. I really appreciate your time and support, and keep making milestones.